Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Net Present Value, NPV, a simple guide to making smarter financial decisions. Making smart financial decisions often comes down to understanding one key concept: net present value, NPV. Whether you're evaluating an investment or comparing project options, NPV answers a simple question: is it worth it? By measuring the value of future cash flows in today's terms, NPV helps you see the bigger financial picture clearly. In this guide, we'll break it down step by step so you can use it confidently in your decision making. What is net present value? Net present value, NPV, is a financial tool used to evaluate the profitability of an investment or project. It calculates the current value of future cash flows, adjusted for the time value of money. In simpler terms, it helps you determine whether the money you spend today will generate enough returns in the future to make it worthwhile. If the NPV is positive, the investment is expected to create value. If it's negative, it may not be worth pursuing. The NPV formula explained. To understand how NPV works, you need to break down its formula. NPV equals sigma, quart, 1 plus R, caret T, C0. Here's a closer look at each component. Quart, cash flow in a given time period. This is the money you expect to earn or spend. R, discount rate, which reflects the cost of capital or required return. This adjusts future cash flows for risk and inflation. T, time period, usually measured in years. C0, initial investment or upfront cost. The formula simply sums up the present value of all future cash flows and subtracts the initial investment. Each cash flow is adjusted by the discount rate and time period. Think of it like this: $10 earned 5 years from now isn't worth the same as $10 earned today, and the NPV formula accounts for that. For example, if you're considering a $100 investment today, C0, which will return $120 in 2 years, quart, and your discount rate, R, is 5%, you would calculate NPV equals 120, 1 plus 0.05, squared, 100. NPV equals $108.90, 100. NPV equals $8.90. Since NPV is positive, this project adds value. Importance of time value of money. The idea of NPV is rooted in the concept of time value of money, TVM. This principle states that $1 today is worth more than $1 in the future due to its earning potential. Why? Because you can invest that dollar today and earn interest, or because inflation may reduce its value over time. NPV incorporates this by discounting future cash flows. It adjusts what you'll earn in the future to reflect today's value. If you ignore TVM, you might overestimate the returns of a project and make poor decisions. Here's a simple way to think about it. Imagine finding $20 in your jacket pocket. It feels like a windfall because you have it immediately. Now, imagine someone promises to give you $20 a year from now. That doesn't feel as exciting, does it? That's the time value of money at play. By understanding and applying NPV, you align your financial calculations with reality. This way, you avoid the mistake of treating future dollars as if they're just as valuable as today's dollars. In short, NPV helps you think smarter about your money, so you invest wisely. How to calculate NPV? Calculating net present value, NPV, may seem complex at first, but it's actually straightforward when broken down into steps. By following a structured process, you'll be able to objectively evaluate whether an investment or project is worth pursuing. Here's a step-by-step guide to help you get started. Step 1. Identify cash flows. The first step is identifying the cash flows associated with the investment or project. You'll need to forecast all expected inflows and outflows over the project's life. Inflows. These are the revenues, savings, or other financial benefits that the project will generate. Outflows. These include costs, like setup expenses, maintenance, or operational costs. Accuracy is key here. Start with realistic assumptions based on historical data, market trends, or industry standards. Aim to list every cash transaction that will happen during the project's timeline. Remember, overestimating revenue or underestimating costs can lead to misleading results. For example, if you're evaluating a new piece of equipment for your business, revenue from improved productivity is a cash inflow. Purchase costs and maintenance fees are cash outflows. By breaking down these numbers year by year and separating inflows from outflows, you'll create a clearer picture of the project's future impact. Step 2. Select the discount rate. The discount rate is where the time value of money comes into play. It determines how future cash flows are adjusted to reflect today's value. Think of it as the cost of money for the project. How do you choose the right rate? Consider these. Cost of borrowing. If you're financing the project through loans, the interest rate could serve as the discount rate. Opportunity cost. This reflects the return you could earn from other investments with a similar risk level. Risk factor. Riskier projects often require higher discount rates to account for uncertainty. For example, if you expect a 10% annual return from an alternate investment, you might use 10% as your discount rate. Be mindful that a small change in the discount rate can significantly affect NPV, so be as precise as possible. Step 3. Calculate NPV. Once you've determined cash flows and the discount rate, it's time to crunch the numbers. Use the NPV formula. NPV equals sigma, quart 1 plus R, caret T, C0. Here's what it means. Quart, cash flow for each specific year. R, discount rate, expressed as a decimal. T, time period for each cash flow, year 1, year 2, etc. C0, initial investment or the upfront cost. Follow these steps. Break cash flows into years. List out each year's cash flows, quart, in a table for easy reference. Discount each year's cash flow. Divide each quart by 1 plus R, caret T. This adjusts for the time value of money. Sum up the present values. Add all the discounted cash flows together. Subtract initial costs. Deduct the initial investment, C0, from the total discounted cash flows. Here's an example. Imagine you invest $1,000 today, C0. You expect returns of $400, $500, and $600 over the next 3 years. If your discount rate is 10%, year 1, $400 per 1 plus 0.10, caret 1 equals $363.64. Year 2, $500 per 1 plus 0.10, squared equals $413.22. Year 3, $600 per 1 plus 0.10, cubed equals $450.25. Add these together. $363.64 plus $413.22 plus $450.25 equals $1,227.11. Finally, subtract the initial cost. NPV equals $1,227.11. $1,000 equals $227.11. Since NPV is positive, the project is likely a good investment. You can also use spreadsheets or financial calculators to simplify this process. Whether you do it manually or with tools, the key is accuracy at each step. Applications of NPV in business. Net present value, NPV, is more than just a formula, it's a decision-making powerhouse for businesses. By converting future cash flows into today's dollars, NPV provides a practical way to evaluate investments and projects clearly. Let's explore 2 key areas where NPV makes a big difference. Investment appraisal. When businesses consider new investments, they need to assess one thing: profitability. This is where NPV becomes indispensable. It helps decision-makers understand whether an investment will generate more money than it costs. Here's how it works. Evaluate profit potential. By comparing the present value of expected cash inflows to the initial cost, NPV shows if the investment creates value. Risk assessment. Using a discount rate that reflects the opportunity cost or risks, you can gauge if an investment aligns with financial goals. Take this example. A company wants to spend $200,000 on energy-efficient equipment expected to save $50,000 annually for 6 years. By calculating NPV, they can see if those savings outweigh the upfront cost, making the decision clear. Businesses rely on NPV to prioritize investments. A project with higher NPV often takes priority because it promises more value for every dollar spent. Project evaluation. Companies routinely face decisions about which projects to pursue. Whether it's launching a new product, building a facility, or upgrading technology, NPV is key for choosing wisely. Here's why it works. Objective comparison. NPV levels the playing field by expressing all project costs and benefits in today's dollars. This eliminates guesswork. Resource allocation. By comparing NPVs across projects, leaders can allocate capital to options with the highest returns. Imagine you're considering two projects. One involves creating a new app, and the other requires opening a storefront. Both promise long-term cash flows but have different costs and risks. Using NPV, you can objectively compare which project offers better financial returns, ensuring resources are spent wisely. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.